Chairman Powell testimony about 60 minutes away. Live from New York City this morning. Good morning, good morning. Equity futures positive by about 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York coming up, Chair Powell facing down the Senate Banking Committee. China pushing back as the U.S. seeks to contain Beijing, and Meta gearing up for thousands more job cuts. We begin with the big issue, the Fed chair on Capitol Hill.
We have Jay Powell's testimony against Congress.
We're going to hear from Chair Powell today, tomorrow.
Senate banking on Tuesday and then House Financial Services on Wednesday.
Everybody's going to be going through this with a fine-tooth comb.
Is he moving in a more hawkish direction? Is he going to move more toward what the terminal rate is now being priced into markets?
I think they'll stick to the script.
He will underscore the fact that inflation continues to be their main objective.
But the real problem is what the Fed are looking for is the data, and Powell isn't going to have the data.
We've got key data coming up.
The payrolls report on the 10th.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
What actually happens in terms of the questioning of Powell is another thing.
59 minutes away and the countdown starts right now with Morgan Stanley's Lisa Shallett and Nuveen's Brian Nick. Lisa, first to you. We hear from the chairman in about an hour. Do you expect him to validate market pricing?
Yes, I do. I think he's going to talk about the fact that the bond market appears to be moving in the right direction, which is acknowledging the Fed's conviction in a higher terminal rate and the reality that we are not seeing cooling in the real economy yet. And we're not seeing enough progress on inflation. Again, I think for the average American, which is what the folks in Congress are going to care about, they're going to focus on the headline inflation, and that's still over 6%. And that's, as we know, 3 times their target.
Brian, are you looking for the same thing?
Yeah, I think one thing that the Fed has accomplished, or really allowed the data to accomplish for it, is sort of goading the market up to where the Fed's own forecasts were, at least as of December. And they're likely to go a little bit higher in March in terms of the terminal rate. But 4 weeks ago, Chair Powell was unable to get markets to tighten up in response to that last FOMC meeting. It was really the subsequent data, the payrolls number from January, as well as the CPI data and a couple of the consumer spending reports that have really gotten the market's attention and alerted investors to the fact that rates are going to have to go higher, perhaps to as high as 5.5%. Or some economists think quite a bit higher than that.
And Brian, now, as you've just pointed out, the market's above the Fed. We've gone from the market below the Fed to above the Fed. And I'm trying to work out when they sit around and put together a dot plot, Brian, at the end of March on the 22nd, what do you expect that dot plot's going to look like?
I think the average terminal rate is going to rise. I think it's going to be more in line with the market. I think the Fed probably is pretty happy with where things are. It would prefer to deliver dovish surprises than hawkish surprises, I guess, at the margin. Getting the market to price in a 5.5% terminal rate, I think makes a lot of sense. There are going to be a lot of dots above 5.5%, but my guess is that median dot's going to be somewhere in that 5 3/8 range.
Elisa, super tricky for the Fed chair to navigate this because this conversation, of course, could completely change on Friday with the payrolls report, could change again on the 14th with the CPI report, and that CPI report comes on the 14th in the quiet period before the Fed meeting on the 22nd. I would go back to some comments he made in the last news conference when he said the disinflationary process had started. Lisa Shallett, you said he'll validate market pricing. Will he de-emphasize that phrase he used early on this year?
No, I don't think he will. I think he will stick to his guns on this idea that the disinflationary process has started. And I do think he can lean on the data in that regard. I think the key is going to be the questions that he gets from congressmen who, as we know, they're there to represent their constituents. They're just going to go right for it. And they're going to say, do you feel that you're making, progress quickly enough? Can you execute a soft landing, et cetera? And I think that the chair is going to try to continue to suggest that is their intent. He's going to take a victory lap on the fact that the labor market is still so strong. But I do think he's going to have to continue to say that inflation is still too high.
Brian, we always tee this up as a bit of a grilling, a face down, a showdown between the chairman and officials on Capitol Hill, and then it gets there and it just turns into a YouTube clip that's being made by a politician to send out to their constituency. Should we expect anything different today?
Yeah, I'd say less of a showdown, more of just a show. The congressmen are there also to get their point across. I think Powell's going to get a lot of pushback from Democrats on the unemployment forecasts, which the Fed has not had a chance to update since December. I assume they're going to go down in March, but they're going to be asking him, why do you think unemployment needs to be 4.6% by the end of this year? And is getting inflation down to 2 or 2.5% really going to be worth that? And he's going to need an answer for that. He's also going to need to be able to explain how it is that higher interest rates getting to 5.5 or even 6% is going to bring down inflation in a way that going from 0 to 5 so far hasn't managed to do.
Mike McKee's down there in Washington ahead of all of this. Mike McKee, what are you focused on?
Well, exactly that. How do they get to where they're going and what are the impacts? If you take a look at the chart that shows where inflation and unemployment are right now, you can see the Fed's dilemma. The Fed is looking at the yellow line, which is PCE inflation, still too high. The white line is where the Fed is now. The dotted white line is where their December 14th dot plot suggests they may go. And the blue line is where unemployment is and what would happen if they went higher. And that's a little corner of the chart over on the right-hand side is what all the argument is going to be about today. Powell is going to, as you guys were talking about, say they are really committed to bringing inflation down to 2% because everybody suffers. Yes, people might lose jobs, but everybody suffers from inflation that's too high, and there may be some pain involved in that. But they want to be cautious raising rates from here. He'll probably say something along the lines of, we're looking at very small moves. Maybe he'll say 25 at default, but he will promise to go over that. They'll go to 50 if they need to, if the data still yet to come suggests that the Fed is behind the curve. And then, as you were talking about, and Lisa was talking about, a lot of questions, a lot of pushback from the Hill today. Is the 2% inflation target still justifiable? Could you do 3? Would it make a difference? How many people will have to lose their jobs? If they go to 4.6% unemployment, as they forecast in December, that's 1.5 million jobs gone. Will there be a recession? When or how bad? Did the Biden administration cause the inflation? That's the Republican question. And are Republicans threatening debt ceiling disaster? That's the Democrat question. So there will be, I think Brian put it very well, a show. Whether it's a showdown or not, we don't know. And whether we get a whole lot out of it, we don't know. But Jay Powell will tell them what most people already know.
He'll spend 2 hours today trying to avoid the politics, 2 hours tomorrow trying to avoid the politics. Mike, he's also got to navigate a tricky point, and you and I have talked about it. This is ahead of payrolls. It's ahead of CPI. How much two-way risk do you think there is in the data? How is he going to approach all of that?
Well, this is such a weird time. We don't know how much risk there is, but the assumption is there's a lot of two-way risk in there. Payrolls were seen as driven by seasonal factors and some unusual post-pandemic statistical situations in January. So there's a feeling they're going to come down, but how far do they come down? And then in terms of inflation, we were making progress. We bumped up again in January. Do we start to go back down again? The Fed sees disinflation in a lot of categories. Do we get the disinflation the Fed's looking for? So Powell can't go too far out on a limb without knowing those numbers.
And Mike McKee, thank you. We get those comments from the Fed chair in about 52 minutes from now. Lisa Shallett, Brian Nick back with us. Lisa Shallett, we've got to take this framework, all this Fed speak, all this good stuff, and plug it into markets. A number of months ago, you said there was a massive disconnect between the bond market and equities. What does that disconnect look like now?
It's gotten more severe. I mean, I think that that's probably the biggest thing that concerns us is that equity investors are behaving in an extraordinarily complacent way during a period of time when the risks, and as Michael said, the two-way risk we see is extraordinarily high. I don't think, I had a mentor, at the beginning of my career, Michael Goldstein, who used to say, nobody knows nothing. And that's where we are at the minute. You've got the New York Fed forecasting, or the Atlanta Fed forecasting a nowcast for GDP for the first quarter, close to 2.5, and you've got the St. Louis Fed, saying, it's going to be a recessionary quarter. Nobody knows what's going on. There's a lot of cross currents, and that's what's not priced into the equity market. There seems to be this belief among equity investors that companies are, quote unquote, going to make the numbers no matter what.
Is that an argument to sit in bonds or sit in cash?
For me, I'd rather get paid to wait. I don't want to take the risk. The market's already up, 5.5%, 6% year to date. I don't want to take the risk right here for an incremental, 2 to 3%, when I could easily have 10 to 15% downside. It's just not a good risk-adjusted return for me.
Brian, Nick, would you take the other side of that?
I wouldn't. I agree with Lisa that unfortunately I think a lot of the gains that we're going to see in 2023 may already be in on the equity side. On the fixed income side, if I'm looking at an alternative to equities, I'm probably not looking at cash or government bonds. I'm probably looking more at things like high yield, where you can get paid 8-9% for below investment grade exposure in fixed income. Trades more like equities, but at least you're getting the yield, which you're not getting provided with the equity market. And if the economy holds up relatively well, but profit margins get squeezed, which I gather is sort of the Fed's goal here in bringing down inflation, then it's possible you're going to see outperformance across fixed income compared to equities over the balance of this year.
And Brian, with a spread of 390 on high yield, what do you make of that?
Yeah, it's come down pretty aggressively. I think what we've seen, one thing we've seen in common between the stock market and the bond market this year is that recession risks have gotten priced out, at least imminent recession risks have gotten priced out pretty aggressively. So you've seen that yield curve even kind of uninvert a little bit for certain terms. You've certainly seen the 10-year a little bit better supported, and you've seen the stock market valuations better supported. I think all that goes to the likelihood of a recession risk, receding a bit, and that is also consistent with the decline we've seen in spreads. But we still prefer less rate risk and the wider spread you're getting with high yield compared to the higher quality, but the lower spread and the more interest rate sensitivity with investment grade.
Lisa, you said you didn't want to take on the downside risk in the equity market. What about the high yield market?
We've been cautious there as well. Our sense is that those spreads are just too tight. We think that the canary in the coal mine is going to come in the credit markets. Thus far, markets have held extraordinarily well. Cash flows have remained resilient, and we've been able to cover. But our best guess is that as we're starting to see these little pieces of news, coming out of the commercial real estate markets on some selective defaults, that's really where you're going to start, getting some warning signals. And, we'd prefer, when you look at the spread between, high yield and investment grade, that's pretty tight too. So, I'd rather play quality here, versus an incremental 30 or 40 basis points of yield.
Elisa, there's a phrase you'll hear a lot of in the equity market. People will say things like valuations are full. There is a question worth asking, Lisa, at what point you would look through that, look past all of that. When is that point?
Yeah, so, for us, and I know you read a lot of work from the team at Morgan Stanley. What we have said very clearly is we're looking for an equity risk premium to expand by about 200 basis points. We're looking for a price earnings ratio that's a lot closer to 15 to 16 times forward. Look, we can get there in a variety of ways, but we need to just see better valuation here before being interested.
Well, clearly right now in this equity market, you don't believe we're there at the moment. Equity futures are just about negative, turning positive briefly. Let's call it flat on the S&P 500. On the Nasdaq, we're positive by 0.1%. Lisa Shallot and Brian Nick there. This from Marko Kolanovic at JP Morgan, who put this out just yesterday, said this: while the day-to-day interplay of investors, speculators, the options market, systematic investors, etc., can produce strong rallies, we maintain that risk assets are in a bear market and will not bottom until central banks start cutting rates. We'll pick up on those comments around the opening bell in just a moment. As I say, about 16 minutes away, equity futures on the S&P totally unchanged. Yields in a couple of basis points. Your 2-year, 487. We topped out last week north of 490. Your 10-year, above 4% last week. In fact, the whole curve, 2's out to 30s, 4+% through much of last week. Your 10-year back below that level to 395 on a 30-year, 388. Should we get you some movers ahead of the opening bell? Let's do that. Here's Abby.
Hey, John. Well, let's take a look at a stock that is popping. That, of course, is Meta. Shares are up nearly 2% on a Bloomberg exclusive reporting that the company is said to be cutting thousands of jobs this week. This is on top of the 13% reduction back in November. That equaled about 11,000 jobs cut. That was the first big layoff ever. The goal, of course, is efficiency, so investors liking the possibility that it is going to help the bottom line. What stands out to me the most about this stock, John, on the year into today, up 53%. We're obviously only about 2 months into the year. That, of course, though, follows a greater than 60% decline last year. As for one stock plunging on the day, we, of course, have Cara Therapeutics down 25%. The biotech company, their fourth quarter revenue missed. They put up a wider loss than expected. This is stoking concerns about demand for their kidney disease drug. JP Morgan sticking with their overweight. There is a 12% bearish short interest on this stock. The range for this stock over the last roughly 9 years, John, between $4 to $30. This binary trading, the worst day today since April of 2021.
Abby, thank you. Coming up on this program, Congress looking to crack down on TikTok.
I got 12 senators, 6 Republicans, 6 Democrats that are co-sponsoring this legislation. Gives the Commerce Department a new set of tools to take on up to banning TikTok as well as other hardware, software, mobile apps.
That conversation up next.
They're collecting data. Many of those folks are young people. They are also, this is an enormous propaganda tool. The Chinese Communist Party can direct what type of videos you're seeing on TikTok. So I think what our bill does gives the Commerce Department a new set of tools to take on up to banning TikTok as well as a host of other new domains where we're going to see foreign technologies, I believe, pose national security concerns.
Washington inching closer to ban the Chinese video sharing app TikTok. Democratic Senator Mark Warner gearing up to unveil the bill, which the White House is poised to support. President Xi rallying the nation today, saying that China has been grappling with, quote, comprehensive containment and suppression by Western countries led by the U.S. The foreign minister adding to those remarks, the United States' so-called competition aims to contain and suppress China in all respects. It is a reckless gamble, with the stakes being the fundamental interests of the two peoples and even the future of humanity. Let's get down to D.C. with Anne-Marie. AMH, some strong words there.
Yeah, tensions rising, Jonathan, between Washington and Beijing, and yet another bill. It doesn't name TikTok in name, but it is another bill that can go after TikTok that will be hitting Congress as soon as today. And what we've heard from Senator Warner, he is one of the co-sponsors of this bill. He says it has bipartisan support with 6 Democrats, 6 Republicans, is that this would give the Commerce Department more tools to mitigate these concerns when it comes to technology that they're worried about national security concerns. So this could be to go as far as prohibiting apps like TikTok, but also software, hardware, AI computing technology, all of this. And it really is an expansion of an executive order that was from the Trump administration given to the Commerce Department. What's interesting about this bill, when you look at a handful of these bills, is that it does seem to be that this has White House backing. But of course, as you just read out what we heard from Qin Gang, the foreign minister of China, whether or not Xi Jinping calling out the United States directly recently, this is just going to add to these tensions and the acrimony between Beijing and Washington.
Anne-Marie, do you think the rhetoric matches what you see in the bill? Within the bill and many of these bills, as you've pointed out, TikTok is not named directly. And as you've pointed out also, this would give the government, the administration, the ability to pursue banning the app if they wanted to. But if they truly believe that this is a tool for propaganda, that there is an intelligence risk associated with this, why is there even a conversation right now?
Well, there is another conversation that is going on that doesn't always get the front page headlines. First, I would say we need to read the text of this bill, which hopefully this afternoon we will have in our hands. But there's another conversation between the executives at TikTok and CFIUS and the U.S. government. TikTok maintains that they can still operate safely in the United States because they would be able to isolate the data. This is going to cost them a ton of money, and it's called Project Texas. They're using a similar format dealing with the European Union, who's also concerned. So potentially, if you look at the intelligence of it and that the community, they may say that at the end of the day, if they were able to isolate this data, this is something that can happen and that they would be comfortable with. The other issue, Jonathan, we talked about this in surveillance, is that this might not bode well for under 30 voters. TikTok is incredibly popular. The younger the youth get, this is where they are getting their news. This is why, though, you have Republicans and Democrats concerned that China could potentially rejig the algorithms. But this is not going to make lawmakers in Washington popular.
Yeah, that shouldn't be a consideration if they're truly worried about an intelligence risk. But I'm not going to go there anymore.
Well, it's politics.
I get it. I get it. Last week, you and I talked about BlackRock, companies like that getting squeezed between blue and red states over fossil fuels. This development right here, AMH, I think is one of the biggest economic stories potentially for our future. Just a breakdown across this country between what red states want from corporate America and what blue states want. And in the last 24 hours, California looking to ban business with Walgreens. You saw the tweet from Governor Newsom, who said California won't be doing business with Walgreens or any company that cowers to the extremists and puts women's lives at risk. We're done. Now, AMH, just briefly, I don't know how much business the state of California does with Walgreens. What are they saying back to this?
Well, John, this comes down to the abortion pill, which is the flashpoint of partisan politics since we saw the overturning of Roe v. Wade. Yes, last week we talked about ESG, but this is a medical issue. And what you see is the state of California taking aim at Walgreens because what Walgreens had said previously, which is that they will not sell this pill in 20 states. But those 20 states that they can't sell those pills because those attorney generals say they're going to get sued. Very complicated story and difficult for Walgreens right now. And
something I imagine you and I will keep talking about. Anne-Marie down in Washington, AMH, always appreciate it. Thank you. Up next, the morning calls, and later, JP Morgan's Tom Kennedy looking for the 10-year Treasury yield to hit 285 by year end. Four minutes away from the equity market open, futures totally unchanged. Let's get you some morning calls briefly. First up, Evercore upgrading Delta to outperform, expecting the airline to benefit from China's reopening. Your second call, North Coast Research upgrading Costco to buy, saying quarterly results have set the stage for a strong second half. And finally, Argus upgrading DraftKings to buy, seeing upside as more states legalize online sports betting. That stock is up 2.6%. Up next, Tom Kennedy at JP Morgan looking for a big move in this bond market. Chairman Powell, Fed Chair, 30 minutes away on Capitol Hill, and your equity market doing absolutely nothing going into the opening bout. Futures unchanged on the S&P and the Nasdaq, unchanged as well on the Russell, unchanged as well. You can see a theme emerging here as we wait for Chairman Powell and his comments. There's your opening bout. Switch up the board and get to the bond market. Yields not doing much either. Basically totally unchanged on a 10-year, 395.58. In the FX market, euro dollar not giving me much. We're down about a third of 1%. 106.50. Amazing to hear some of the comments from Holzmann, the National Central Bank Governor of Austria, in yesterday's session, teeing up, pushing for 4 more 50 basis point hikes from the ECB. I get it, he's an outlier, he's super hawkish, but the fact is that's going to be part of the conversation on the Governing Council later this month with him pushing his agenda. My question is, they'll go 50, okay, will they tee up and commit to another 50 basis point hike at the same time as saying we don't do forward guidance? The whole thing's ridiculous. Crude right now, holding on to 80, we're down 0.4%. WTI $80 and about 14 cents. We are 40 seconds into the session. Your equity market opens up like this on the S&P, dead flat on the Nasdaq, unchanged. That's the theme right now as we wait for Chairman Powell, 29 minutes away. One stock to watch at the open, Dick's Sporting Goods. The company's forecast topping estimates and sounding confident it has resolved its supply chain issues. The CEO said this: as planned, we continue to address targeted inventory overages, and as a result, our inventory is in great shape as we start 2023. Abby has more. Hey, Abby.
Hey, John. Well, shareholders really rewarding the stock right now. Dick's is popping more than 5%, the best day of the year since last December. And of course, it does have to do with that outlook. They also put up a solid quarter. They saw a second quarter of same-store sales growth, that after 2 quarters of declines last year. And that, of course, had to do with those inventory issues and perhaps also the macro around the idea that last year there was expectations for a big recession. Consumers slowed down, but up 5.5% in the fiscal fourth quarter that ended in January. As for the quarter that was, not surprisingly, they beat top and bottom line estimates, not by a huge margin, but there was a beat, really reiterating the idea that demand for sporting goods items, well, it is in place. And that outlook, as you mentioned, they raised it. They also more than doubled the dividend. So good things here for Dick's Sporting Goods. As for the stock on the year, it is outperforming. Right now, it's after today's. Actually, this is the 1-year view, up 42%. Now, Hibbett, a smaller competitor, is a little bit higher, and Big Five is down. But on the year, Dick's Sporting Goods is beating these other 2 stores, really blowing away the competition, especially after these results, John.
Abby, thanks for that. We're also watching the airlines as well. JetBlue and Spirit said to be facing an antitrust suit from the DOJ as early as today. JetBlue responding in an email to Bloomberg, writing this: we believe there is a high likelihood of a complaint from the DOJ this week. We have always accounted for that in our timeline to close the transaction in the first half of 24. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, so they anticipated a bit of regulatory pushback here. That isn't to say, though, that investors weren't a bit surprised by this. You saw that reaction really yesterday when Spirit shares were down the better part of 9%. But here at the open, a little bit of a rebound taking shape, now up about 1.3% in the first few minutes of trading. JetBlue, for its part, is up by about 0.5%. I would note that this isn't just about the Department of Justice filing suit against this $3.8 billion takeover, that they are expected to file that in federal court this week, alleging that the elimination of Spirit would increase ticket prices and decrease options for travelers. But also, the Department of Transportation is expected to begin a parallel proceeding to block the transfer of Spirit's operating certificate as incompatible with public interest. That is largely unprecedented in the modern era, John. We haven't seen the DOT use its authority to block the transfer of a certificate like that since 1978, all the way back when the airline industry was deregulated. So this is really significant here. And again, it all comes back to the availability of discount flights or cheaper flights for consumers on different routes. All of that said, though, even if JetBlue and Spirit ultimately succeed in combining, they will still make JetBlue only the fifth largest U.S. carrier based on domestic traffic. So it is still smaller than the likes of American, but nonetheless, the merger here of these two could give JetBlue more pricing power that will ultimately impact how the other major airlines have to change their prices as well, John.
Kelly, thanks for that. One to watch. You'll be covering it, no doubt. That stock is up by a little more than 1%. One call to have a look at, Evercore, upgrading Delta to outperform, seeing an improving backdrop for the airlines. The analyst had this to say: fuel prices are behaving, China's reopening is a positive development, and recent pilot contract negotiations has lowered Delta's cost outlook uncertainty. The stock's flying year to date, excuse the pun. Delta up another 1.9% in today's session. Elsewhere, from airlines to automobiles, Rivian shares under pressure after announcing plans to raise more than $1 billion through the sale of green convertible bonds. That stock is down 7.6%. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. The downward pressure on the stock reflecting that issuing convertible bonds can potentially have a dilutive impact on the shares outstanding. As our colleague Joel Levington in Bloomberg Intelligence points out, this kind of shores up the liquidity story around Rivian, which ended the fourth quarter with around $12 billion of cash equivalents and unrestricted cash on its balance sheet. But investors have had concern about the rate of burn that this company is going through as it ramps up production. The green angle, also interesting, of course. This is a maker of electric vehicles with longer-term, broader ambitions around the transition to clean energy. But it does add to an existing debt pile, these green convertible bonds due in 2029. The issue of converts is kind of interesting to me, right? For investors, this is an opportunity to get an interest payment with, the right but no obligation to convert to to shares. For Rivian, this is taking advantage of a cheaper means of raising funds amid higher interest rates. But look to the equity story, right, and that share performance on a 12-month basis or more. You kind of get why they might do this, John, instead of just going directly to the equity market. It's an interesting situation for Rivian, and they're kind of following others in this space. I'm thinking, of course, of Lucid, that look to the same mechanism.
Looking forward to your coverage on the tech show later, Ed. I just wanted to squeeze one in just to follow up to our
Sure.
conversation earlier this week. The price cuts again at Tesla. How are people responding this time around?
Yeah, look, earlier price cuts in the year unlocked pockets of demand. What I would say about the Model S and Model X is very low volume production, 100,000 units just out of Fremont, and they're still very expensive. There's an interesting debate about the rationale behind it, given that they're still outside the scope in some sense of the IRA tax credits. But, you know, this is a lever that Tesla's using. Other automakers are following suit. And the outperformance of the shares year to date to some peers suggests that analysts in the street see it as a useful mechanism to find those pockets of demand, particularly here in North America.
Tough year last year, massive year-to-date gains this morning, down about 1%. Ed, thank you, sir. As always, the broader market looks like this, 7 minutes in, unchanged on the S&P, slightly firmer, stronger, higher, positive on the Nasdaq, up 0.2%. Tom Kennedy at JP Morgan has this to say on the bond market. We expect the Fed to keep hiking rates by 25 basis points until payroll growth slows materially to less than 100K monthly payroll gains. We expect that criteria to be met as we approach mid-year. Tom, I'm pleased to say, joins us right now. Tom, great to catch up with you, sir, as always. 23 minutes away from Chairman Powell. If I looked at the January data alone, reported in February, I'd look at that and say we are not sufficiently restrictive. When you look at the complete picture, Tom, are we?
Good morning, John. Yeah, I do think we are restrictive. Powell has used this word, the disinflationary process, and to some degree, John, the market has said, oh, wow, this is the immaculate disinflation we've been expecting. But really, when I hear Powell talk about that, I think he's really describing the road to recession is about halfway paved. What I mean by that is we're getting every indication that rates are restrictive in America. And the things that I look at, number one is the housing market. You have this rare situation where construction completions are higher than construction starts. And you can imagine if you're a builder and you're completing 10 jobs and you're only rolling crews over to maybe 8 jobs, layoffs will happen. Second is in the capital investment or corporate capex space. Capital availability is quite low and suggests capex will continue to deteriorate. And then lastly, you're finally starting to see auto and credit card delinquencies pick up, albeit very low levels, John, but there's good reason to believe the disinflation process is well underway because we're getting firm evidence that higher interest rates are restrictive here.
So, Tom, when you look at a downturn, anticipating one, it's the 3 Ds, depth, duration, dispersion. Can we just deal with the third D there, dispersion? Are you seeing that weakness spread as the months go by?
Yeah, I think this road to recession, or really road to layoffs, John, is non-linear when the Fed is tightening rates. Housing and tech are very, quote-unquote, interest rate sensitive. Construction and housing, I think, is obvious when you have a short mortgage cycle. But for tech, we had a decades-long equity availability of capital, and that's been shut down by the Fed as well. So those are going to feel the impacts first. But, John, if we're sitting and Powell and team at the Fed, what do they really want? They want more broad-based layoffs. I think the sectors we should be looking most at are construction, manufacturing, and unfortunately finance jobs to see evidence of progress along that roadway.
Claims, as you know, 190. The last jobs report, 517,000. Unemployment, 3.4%. The estimate for this coming Friday, I've got the estimate right now at 224 in our survey. That's a moving target, of course. That's the median estimate in our survey so far. More estimates will come in, but let's go with the 224. You're looking for sub 100K, in your words, as we approach mid-year. Tom, what is it about the glide path that you see? What's important about mid-year?
I think what's important about mid-year is you'll have a long duration period, almost a year, of positive real interest rates and restrictive financial conditions that take time to move through the economy. John, this week, expecting 200,000 jobs added is really a continuation of the slowdown in job growth we saw in the back half of last year. It does suggest January was the anomaly. I think there's good reason to think that too. It's very rare historically to see 500,000 jobs added in a month. I think we naturally all should have a statistical asterisk on there. But I think the deterioration is just a continued roll through of slow capex, and companies do billions of dollars, like JP Morgan, billions of dollars of capex every year. If we're slowing our capex, revenues for others are starting to slow. We're in step 3 already. This is step 3 of the roadmap. And what am I really describing is a world where earnings deteriorate. Q4 of last year, average S&P 500 earnings are down 5%. This is underway. I think it will just take more time. And then step 4 is where you actually see businesses defend their margins. I'm expecting that around mid-year, John, but this resiliency piece that you're highlighting may push that out a little bit, but doesn't mean it doesn't happen. We're having a conversation about recession at the same time David Solomon speaking at an event over at Goldman Sachs. It's an RBC conference. The Goldman Sachs CEO says a chance of a soft landing is meaningfully higher. Tom, you have to confront both sides of the debate each and every time. You also have to look at the menu in fixed income at the moment, 2s out to 30s, and make a point that you want to advocate for purchasing somewhere across the curve. Tom, as you put it all together, the debate, arguments on either side, look 2s out to 30s. What do you like on that yield curve right now? I like to have some sort of duration for my clients because, John, first and foremost, they don't have much of it. I want them to be adding and locking in yields here because I do see those rates as restrictive, and by definition, if they are restrictive, they'll go down in the future. It's a simple conversation with a client, John. It starts like this. Do you think a 5% T-bill is attractive for your portfolio? Unanimously, I see yes. Okay, well, why wouldn't you want to lock that in for, say, 5 years? And it's just a way to start to engage them of what do you want your money to do for you? And finally, John, for the first time in 15 years, we can help clients reach their portfolio goals with less risk. So ultimately, I want them to be adding duration, and in our community at JP Morgan, it ends up looking like a 5-year municipal or investment grade bond. And maybe even looking for 285 on a 10-year by year end. So let me take that argument for bonds. Tom, if that's an argument for a 10-year, is that an argument against equities? I don't know that it's necessarily so, John, let me say no. You can have equities for your appreciation and bonds for your confidence in your portfolio total returns. So you can own both. I think for the marginal dollar spent here, it's fixed income far and away. The earnings yield on the S&P 500 is about the same as a 12-month T-bill. When you show that to a client, well, the S&P has some risk and T-bill really has negligible risk. So how can it be marginal dollar spent in this risk bucket? So I just think you have to give people this what's in the price concept and let them see the value for themselves. Tom, just a final one. The chairman in about 17 minutes' time. Members of Congress do watch this program, and if someone from the Senate Banking Committee is watching right now, or maybe a member of the House Financial Services Committee for tomorrow, what's the question you'd like them to ask? I want Congress to ask the question about confidence in the progress. And I would like to see Powell really emphasize this disinflationary process being underway as progress towards the layoff cycle, not progress towards immaculate disinflation. Politically, let's see how that argument goes. Tom Kennedy, thank you, buddy, over at JP Morgan. Appreciate it, as always. About 15 minutes away from hearing from Chairman Powell. Coming up on this program, another round of tech layoffs.
Focusing on the bottom line, creating efficiencies, those are value company techniques to create shareholder value. And I think that's what Meta is being forced to. But overwhelmingly, the tech sector is overhired. There's probably more redundancies coming from all of the big cap tech going forward.
Meta is gearing up to make another move. That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Jeremy Weir, Trafigura CEO. That's at 1:30 p.m. in New York. This is Bloomberg.
Companies, the stock market rewarded them for growing, attracting users, not generating profit necessarily. And I think Facebook or Meta has acknowledged now that it's more of a value company than a growth company, and focusing on the bottom line, creating efficiencies, those are value company techniques to create shareholder value. And I think that's what Meta is being forced to. But overwhelmingly, the tech sector is overhired. Basically, to achieve that growth that the market was rewarding, there's probably more redundancies coming from all of big cap tech going forward.
Meta planning a fresh round of layoffs. Bloomberg reporting the company is looking to cut thousands as soon as this week. This coming on top of a 13% reduction to its workforce back in November. The CEO, Mark Zuckerberg, saying at the time, "I view layoffs as a last resort, so we decided to rein in other sources of cost before letting teammates go." Overall, this will add up to a meaningful cultural shift in how we operate. We'll roll out more cost-cutting changes like this in the coming months. And here we are in the month of March. Ed Ludlow, you helped break this story. Can you help explain to us where these job cuts are going to drop across the company?
Yeah, broadly, what we're learning from sources is that director and vice president level staff have been instructed to draw up lists. And as you said, Jonathan, those layoffs could come in the next week as those lists are finalized. What we know from one source is that Mark Zuckerberg himself is due to go on paternity leave. His wife is expecting their third child. The hope from those management level staff is that those lists are finalized and those layoffs conducted by the time that happens. There is also a financial target that we're told, and that's interesting because the context here is the bloat of the pandemic era, right? And one gauge that we've been tracking is the additional units of revenue added per additional headcount over the pandemic period. If you stack Meta alongside its mega cap tech peers, Meta's pretty firmly bottom of that pile in terms of the new revenues they were able to add by growing staff in the pandemic era. We know that they've added subscription, a level of subscription tier for some of their products. I reported last Friday, John, that the impetus for cutting prices on the AR, VR headsets was simply a lack of demand. They're not able to sell any. So there's a lot of pressure to make this happen, and what we're hearing is that it will happen soon. It will be pretty broad-based. I'm told by one source those original 11,000 cuts at the start of the year were very forensic, very planned. What I'm told this time around is it's more of a sledgehammer approach. They have to meet these targets. They have to make these additional layoffs, which are separate to the 11,000, separate to that management flattening, and it will be strong.
What a change. What a change for this company in the last 12 months. Ed, thank you, and tremendous reporting, sir, as always. Thank you, buddy. Thinking about these tech cuts, still not showing up in the broader labour market at the moment. Jobless claims still in and around 190. Looking ahead to payrolls, if you missed that number a little bit earlier in the programme, sneak peek of payrolls Friday, the estimate so far in our survey, still north of 200,000, 224,000. A previous number was just a blowout 517. This is what Chairman Powell has to confront in about 9 minutes' time. He's got to look for the data on Friday and payrolls, and then CPI on the 14th drops in the quiet period ahead of the Fed meeting on March 22nd. He's going to face 2 days of questioning from lawmakers on Capitol Hill. 10 a.m. in front of the Senate Banking Committee. That's about 8.5 minutes from now. Then on to tomorrow at 10 a.m. Eastern Time, again in front of the House Financial Services Committee. This time, Mike McKee's back with us for a final word. Mike McKee, looking ahead to this one, your focal points, what you are really looking to narrow down on with Chairman Powell later, what are they?
Well, I'm going to pick one thing, John, and that is why hasn't unemployment risen even though the Fed has raised rates by so much? You talked about jobless claims not moving. Will they start to move soon because people who have gotten severance are no longer getting it and they can file for claims? Will companies suddenly start to lay people off? That'll be an interesting question to get Powell's answer to.
Mike McKee, looking forward to it. 8 minutes away from that testimony on Capitol Hill. We will, of course, bring you those headlines and that testimony right here live on Bloomberg TV and on Bloomberg Radio. Just like we were going into the open, coming out the other side, your equity market, it's going nowhere. The S&P 500 totally unchanged, on the Nasdaq positive by about 0.2% or so. Yields come in a single basis point at the front end. Your yield now 487 on a 10-year, just short of 395, down a single basis point there at about 394-ish. Let's get you some sector price action. Here's Abby.
Well, once again, John, we're looking at anemic volume, but the S&P 500, as it flips ever so slightly higher, up for a fourth day in a row, potentially the best streak since the middle of January. It's all about the mega cap tech sectors that are leading today. Communication services. Actually, we have utilities sneaking in there. Consumer discretionary higher. Dix, I should mention, hit a record high earlier. To the downside, though, we have energy and materials. And over the last year, you were mentioning those David Solomon headlines. Over the last month, I should say, Banks, interestingly, down, even though yields are sky high. John, this could have something to do with banks now having to give money out on deposits.
We'll see if that develops just a little bit more. Finally getting some interest in the bond market, some real income. Up next, your trading diary, Chairman Powell, 6 or 7 minutes away. So these are the scores going into Chairman Powell. This is how the stage is set. Equities totally unchanged on the S&P 500 on the session, on the Nasdaq positive by about 0.25%. In the bond market, not too different. On a 2-year yield, we're down just a single basis point. On a 10-year, similar move. That's the price action. Let's get to that trading diary. Top of the hour, Fed Chair Jay Powell kicks off 2 days of congressional testimony. ADP jobs numbers, monthly jolts, that comes out tomorrow. President Biden releasing his budget proposal on Thursday. Governor Kuroda's last BOJ rate decision on Friday. And finally, the main event, it's payrolls coming up on Friday. Before we get there, it's the chairman of the Federal Reserve, 4 minutes away.